Investment Officer of Summit Global Investments, Jeff Hirsch, also with us. He's on the phone, Editor-in-Chief of the Stock Traders Almanac. Gentlemen, thank you both for being here right now. David, we'll start with you. This technology trade has been the driving force behind the rally that we've seen, no doubt about it. Why is it that this trade is still very much a focus, and can that rally continue?
Yeah, I think one of the things is that this magnificent seven, if we want to call Apple, NVIDIA, Microsoft, Meta, Tesla, Amazon, etc., these individual companies are doing very, very well. And so from a tech perspective, even though we're rather defensively playing right now and we're a defensive manager or we're a risk manager, the reality is this trade probably continues, and this breather is probably good for those stocks. If you look at them long term, I don't think we're going to get the prices we had in some of these individual names that we had back in December. So overall, I'm defensive on the market. I'm a little cautious on the Fed, but I'm positive on this area.
So there is the kind of bigger case and the story around it. Jeff Hirsch, you've studied this for a long time, you and your father both, with regard to seasonality and trends in the marketplace right now. Can you tell us, we've heard a lot of stories about how April is good for the stock market, but how are the charts lining up? Is it validating some of that historical seasonality positively for the month of April?
It is validating that. I mean, remember, we're in this sweet spot of the four-year cycle. We've been bullish since last October. But Nasdaq, the QQQ, the NDX in a new bull market, pretty much up about 23.4% from December low to the March close, is still a little bit behind the sweet spot averages. So a lot of the headwinds and obstacles out there are keeping that back. But April across the board, very strong. Technically, things are looking really, really sharp and really supportive over the last few weeks, but there's still some work to do. Here it is, April, great month across the board, but last month of the best 6 months, we're starting to think, time to do a little spring cleaning, look at the portfolio, be a little more cautious. We're bullish for the year, but worst 6 months can be troublesome, especially in a pre-election year with a debt crisis looming over the market that no one's really talking about right now. So we have some gains here. We're looking to capitalize on that, but moving into the end of April and into May, June, we're going to start looking to rotate and tighten up stops and clean out some underperformers in the portfolio. All
right. Speaking of positioning right now, David, there's a case to be made that you should be doing a little bit of at least fine tuning if you're hypersensitive to some of these risk factors that are out there, whether it be interest rates, the Fed, a banking crisis possibly bubbling up again. What exactly is the tilt right now? Is it towards those defensive stocks that are outperforming today? I highlighted utilities, healthcare, and staples all outperforming today's trade.
I think you do have to have a tilt in your portfolio. There's no doubt that we've had zero capitulation. The Fed is still out there. You name some of the other risk factors that are out there. The market is in the, it's really not completed the bear market trade. So I think you have to give attention to some of these macro factors that are going to impact the market. And you have to have, I think, some weights in your portfolio overweighting some of these areas, whether you get that through a defensive manager or an ETF that like what we manage, or whether you get that through your individual positions and stocks. I think that's very vital in the portfolio today for investors.
So, David, let me follow up then. What stocks are there in your portfolio that you are allocating to clients right now to play out that defensive trade that you're laying out?
I think there's two ways to go about it. One is positioning into some stocks, like we mentioned some. I'll give you one, for example, is Intuit, high quality earnings, superior margins. Any stocks that you're looking at beating on the top and the bottom lines, they provide constructive outlooks. They should have an increased chance of outperforming their peers in the months ahead. Having said that, one of the better ways to go through your portfolio, and I like, what was said, do some spring cleaning. There is a lot of stocks that are, quite frankly, not worth owning. They have too much risk. The idiosyncratic risk or company-specific risk of these stocks are not worth it. So, for example, if you're owning a Southwest Airlines, for example, Southwest Airlines, oil's going up. We know that. They've had problems multiple times in the year. There's better options out there.